All right, part 3 of chapter 16, our final video. So here we are looking at our cash flows from financing, and we're looking at that same 3-step analysis where we're going to identify the changes in the financing related accounts, and then we're going to determine the cash effects using T accounts and reconstructed journal entries, and then we're going to report the cash flow effects. So we're going to be looking at all the changes in all non-current liability accounts, including the current portion of any notes and bonds and equity accounts. These accounts are going to include long-term debt, notes payable, bonds payable, common stock, and retained earnings. Reporting of our financing activities is identical under the direct method and the indirect method. Remember, we're using this 3-step process of analysis. We are going to, again, use the 3-stage process to determine cash provided or used by financing activities. First, we're identifying the changes in the financing related accounts. Then we're going to determine the cash effects using T accounts and reconstructed entries. And then we're going to report the cash flow effects. So let's look at our example here. We have information for Genesis looking at 2 transactions involving non-current liabilities. Genesis retired notes payable by paying cash. So our notes payable transaction, the first step in the analysis of the notes is to review the comparative balance sheets that are shown here. And the analysis is going to reveal an increase in notes payable from $64,000 to $90,000. Once we know that $26,000 increase, then we can look at our next step. So we're going to have the reconstruction of our journal entry up here. Step 2 is explaining the change in item E. We have notes with a carrying value of $34,000. They're being retired for $18,000 cash, which gives us a $16,000 gain. So if we put that entry together, we would see a debit to notes payable for $34,000, a credit to the gain on retirement of debt, and a credit to cash for $18,000. So that's our reconstructed journal entry. And then we can take that change of cash, $18,000, that's what we're looking at to put into our financing activities section. Remember, we're trying to narrow down what happened in cash. All right. We also are going to be looking at our equity accounts. The first is the issuance of common stock for cash. So the first step in analyzing the common stock is to review the comparative balance sheet that we saw before, where it revealed an increase in common stock from $80,000 to $95,000. The second step explains this change using the T account. So item D, the additional information provided earlier, reports that 3,000 shares of common stock are issued at par for $5 per share. So our reconstructed entry for analysis of item D would be shown here. We would be debiting cash and issuing common stock by crediting common stock, both for that $15,000. Step 3 reports the cash received from the stock issuance in the financing sections. So here we saw that $15,000 change in cash. That's what we're reporting under financing. When we look at our next part, we have our retained earnings. So we had to look at the equity accounts again. So we have a declaration and payment of a cash dividend. So our first step is to analyze the retained earnings account to review the comparative balance sheets that was shown before, and it showed an increase in retained earnings from $88,000 to $112,000. So we have to look at, well, what happened in retained earnings? Well, item F of the additional information provided showed that we had cash dividends of $14,000 being paid. So cash paid for dividends was $14,000. So now we've identified all of the cash inflows and outflows, and then we had one non-cash investing and financing transaction. So let's look at our balances. So we start here with our net income. We added in the income statement items that does not affect cash. We looked at our changes in current assets and current liabilities. That gave us our net cash provided by operating. Remember, provided by means it's positive. Used by is negative, or we'll see that down here under the financing. So under investing, we had one item. So investing only changed by $2,000. And then financing, we had 3 items, which gave us a negative number, which is why we listed net cash used in financing activities. That gives us a net increase in cash of $5,000 if we take 20 plus 2 gives us 22, minus 17 is 5,000. That is the change amount we had. So we had 12,000. We add the increase to what we started with, and it balances out to show us our ending. And that's what we want to see, those changes. Here's just a summary of our T accounts to kind of show those changes in the non-cash balance sheet accounts. So it shows how we can see the non-cash balance sheet accounts affect our cash inflows and our outflows. The top part of the exhibit shows the company's T account, their cash T account, I'm sorry, and the lower part shows the T accounts for its remaining balance sheet accounts. We see that the $20,000 net cash provided by operating activities and the $5,000 net increase in cash shown in the cash account agree with the same figures in the statement of cash flows that we just saw. So we have 5 parts that we can go through and kind of look at this. Entry 1 records $38 of net income in the credit side of the retained earnings account and the debit side of the cash account. That $38 net income in the cash account is adjusted to reflect the $5 net increase or decrease. Entries 2 and 4 add the $24 depreciation and the $6 loss on the sale to net income and subtract the $16 gain on retirement of notes. Entries 5 and 10 adjust net income for changes in current asset and current liability accounts. Entry 11 records the non-cash investing and financing transaction involving a $60 purchase of assets by issuing $60 of notes. And then entries 12 and 13 record the $15 stock issuance and the $14 dividend. So that's how we can use our T accounts to kind of summarize what we need. All right, let's look at our last part for the chapter. So at the end of every chapter, remember, we have our ratios. This time we have a total assets ratio that we're looking at. So managers are going to review our cash flows to make business decisions. Creditors are going to evaluate a company's ability to generate enough cash to pay the debt. Investors are going to assess our cash flows before buying and selling stock. To be able to provide answers to all three, it's important to separately analyze investing, financing, and operating activities. To illustrate that, consider the information from 3 different companies that they show us here: BMX, ATV, and Trex. So these companies operate in the same industry and have been in the business for several years. Each company generates an identical $15,000 net increase in cash, but its sources and uses of cash flows are very different. Our BMX example has operating activities provided net flows of $90,000, allowing it to purchase plant assets of $48,000 and repay $27,000 of its debt. ATV's operating activities provide $40,000 in cash flows, limiting its purchase of plant assets to $25,000. Trex's $15,000 net cash increase is due to selling plant assets and incurring additional debt. Its operating activities yield a net cash flow outflow of $24,000. Overall, the analysis of these cash flows reveals that BMX is more capable of generating future cash flows than ATV or Trex. So let's look at how we can see that. Well, the cash flow information we're going to be looking at is the company's ability to meet its obligations, pay their dividends, expand operations, and obtain financing. So the cash flow on total assets is shown on here, and the formula for it is operating cash flows divided by average total assets. So this ratio is going to measure the actual cash flows, and it's not affected by accounting recognition and measurement. It can help estimate the amount and timing of cash flows from operating activities. Okay, that is the end of chapter 16. I hope we've given you a clear introduction into it. Remember, a lot of this is formatting for chapter 16, knowing where to put things, when to add, when to subtract. So use the guides that have been provided and use the examples that are in your book and in the PowerPoint and any other examples you may find.